Hey guys, welcome to Michael's Money School and another brand new video. So for those of you that haven't joined me before, my name is Michael and this video is all about ways to be smarter with our money and put it to the best possible use. In today's video, we are going to be talking about ways that you could start working harder with your money and look at investing it and how you can do that. So a recent survey revealed that the average person saved a huge £495 every single month during lockdown, which is massively increased from before. And obviously with people earning money at a steady rate coming in, I was furloughed, my money was reduced, but my outgoings was also significantly lower. So people aren't going out, you can't go to the shops, right? You can't go to your favourite stores, you can't go to restaurants, you can't go to bars. So really you're just restricted to buying things online. And not everybody's that massive on buying things online. I know I'm certainly not. I like to go and see things in stores for myself. And due to that, I have, like many other people, a huge surplus now of money in my bank account, which I wouldn't have had before. And it's sort of burning a hole. What do you do with that? Do I go out and just spend it? Do I keep it in my savings account? My rates are quite poor. Do I invest it? Like, what do I do with that money? So today in this video, we are going to go through some of the options you have at your disposal to put that money to the best use possible. So the most recent data from the Office for National Statistics has stated that there was £157 billion saved by the UK in the past 3 months. 11 billion of which was pumped into easy access savings accounts during March and April, which is huge, right? Because last year, at the same period, 2.9 billion was being saved. So that's up like such a massive amount. And this extra money is fantastic. I'm really glad that people have got into the habit of saving that money and are looking to save and put it into accounts. But let's just explore some options to make it work slightly harder. I've just mentioned that savings accounts have typically quite low interest rates and there's not going to be a real healthy return on that money. So while less spending doesn't really bode too well for our economy, this newfound passion that the UK has for saving money can only really be a good thing. Unfortunately, interest rates remain pretty low and it makes little sense to put your money into instant access savings accounts. Therefore, there are much better ways to make your money go a little further and get you better returns. Investing is definitely a way of trying to beat the interest rates set by the banks. Typically, a return is much higher than a normal savings account with a high street bank. Of course, you run the risk of losing your money, and the peaks and troughs that go with stocks and shares in the stock market are commonplace, happen every single day. So you have to factor that into your decision. But generally over the long term, and we're talking about a long 10+ year period, the chances are you're going to be quite okay and make a significant return. But before anybody puts any money into investing, the first thing you should be thinking about is clearing of any outstanding debts. Look at any credit cards you may have, potentially loans as well, but more credit cards should be your focus right now, and look at trying to chip away at that balance. Interest on a credit card can be anything from like 10 to even 50%, even higher, which is absolutely astronomical. It's too much money. And anybody that's paying this interest, I will urge you so strongly to look straight away for a 0% balance transfer card and move that money over. Anything you're then paying off is coming purely off the balance of that card and you're not paying any interest to any bank. But ultimately, however you tackle your credit card, the main focus is to clear that balance and get it down to zero as quickly as possible. So the reason I push clearing your credit cards or any debt as fast as possible before investing anything is that any returns you make on your investment are likely to be significantly lower than the interest you're paying out. £1,000 on a credit card with an APR of 18% would cost you around £180. Alternatively, £1,000 in an instant access savings account, and let's be honest, 1.5% is ambitious right now, is going to earn you around £15. So £180 going out versus £15 going in. I mean, I know where I put my money and it is not investing, it's clearing that card and getting that debt gone. So once you have cleared any debt, the next step should be to build up a rainy day fund. And this is just a pot of money which you keep to one side in case of any emergencies. In a previous video, which I'll link below, I discussed how to build up this money and what your main targets and goals should be. But ultimately, about 3 months of money to cover your essential bills that you have to pay out every month, could be rent, mortgage, any utility bills, factor food into that as well. That should be your rainy day pot, and that just sits in a side account and you forget about it. If the worst was to happen and you lose your job, which right now no one knows what's going to happen, that will see you through for at least 3 months. Anything on top of that, fantastic. The more you can save, the better. But 3 months really is a minimum. Hopefully within 3 months you can sort yourself out and get yourself back on track earning some money. Once you've covered both of these areas, now's the time to start looking at investing your money. And what route you go down ultimately depends really on your short term, your medium term and your long term goals. I have touched upon this in more detail in a previous video, so have a look through and see if you can find that one. I'll link it below if you can't. But basically the route you go down can really differ depending on what you want out of that money and what you're looking for in terms of time frame. Are you looking to buy your first house? Are you looking to save for your pension in 30 years time? Are you looking to retire in 5 years time? These are all things you should consider before you put your money anywhere. So these different goals, like having your deposit ready in 5 years, a big wedding, a small wedding, retiring early, saving for a pension in 30 years, these all have different time frames and different levels of risk associated to them. Depending on that level of risk and the time frame, investing might not be the right solution for that specific need or purpose. So now you've thought about your goals and what you want to do with that money, we need to look at what you need to do to get there and how much you should be setting aside to reach that goal in a realistic time frame. The next thing to consider is, are you looking for an income from that money straight away, or are you happy to reinvest that money and let it grow over a period of time? If you're looking for a small income to top up your pension each month, then reinvesting that money is not really going to work for you. You want to draw an income from that straight away, and that makes perfect sense. If lockdown has taught us anything at all, it is to differentiate what is an essential spend, so our bills, and what's a necessity, or what's not a necessity. So what can you cut out? I mean, right now we're used to living without going out every week and spending money on meals. We're not going to the bar every 2 days. We're not going to clothes shops and blowing money on tops and jeans. Like, we've learned to cut that stuff out, which is why everyone's now saving £495 a month, which is fantastic. So that essential income, we've all come to terms with it. We now know what the difference is between the two. So knowing what you need to draw out of that saving and what you can put back in should become a lot clearer. However, if you are saving for a set amount of money, for example, a house deposit, reinvesting any money you make on dividend payments is going to really propel your savings forward at a much faster rate. So this is called compounding, and the whole art of compounding is that your initial investment sits there and it still continues to grow, right? But any dividends that come in are reinvested back into that sort of pot of money. So you're buying more shares with the money that's coming back in, and it's going to snowball. And the more you have, the faster it's going to happen. And this is a really great way to save over the long term. It's not really a short-term solution, but for things like house deposits, it can work as long as you give it enough time, and that's crucial. Anything less than 5 years, you're kind of risking it a little bit. 5 to 10 years, okay. 10 years plus, fantastic. And the amount you need for deposits nowadays, 10 years is not by any stretch out of the realms of possibility. It's quite likely you'll be saving for 10 years for your deposit. Of course, investing comes with risk and nothing is guaranteed. So have a real hard think about what you want from your money and how much you are prepared to lose, if anything. If you can't afford to lose any of it at all, you can't risk a single penny, then this really isn't for you. You have to be prepared to take the rough with the smooth. And yeah, your money can grow exponentially and you can make a real good return, but equally it could drop and you could lose £1,000 plus. It really, no one knows. So you've got to be comfortable with that, and you need to do your research. So let's talk about how you can invest. So there are several ways to invest. The options can be overwhelming and it can seem a lot more complicated than it really is. I will do separate videos on each of the methods I'm about to talk about, but let's just go through it really briefly today to give you an understanding of your options and what possibilities are out there. So saving for your first home or for retirement, you could look at a lifetime ISA. And the lifetime ISA has got a lot of restrictions. Again, like I mentioned, I'll go through another video just to break it down a bit further for you. But this is a way just to save your money with a nice government bonus on top when you come to draw that money out. A self-invested personal pension is another option for retirement. It's also called a SIPP, S-I-P-P. And this is a great way to put money towards your retirement in addition to what you may already be putting into a workplace pension. I would always suggest that you max out the contributions to your workplace pension if your employer is going to match it. It's basically free money and you're turning it away for no reason. So I'd capitalise on that first. Once you've reached that limit and that ceiling, maybe look at a SIPP and just see what you can do elsewhere. There are other providers that can give you different levels of risk, and there's different avenues you can go down. It's a really healthy way to look after your money. I have one, and again, like I mentioned, I'll do a separate video on this for you as well. There are also stocks and shares ISAs. There are fewer restrictions with these, and most good platforms will offer them. Some charge a small fee, like Free Trade will charge you £3 a month. Others won't. So have a little look around and see what ones work best for you. But ultimately, it's down to you to put your money to the best possible use within this ISA. and the fees associated with that, you need to do your research and just work out which one you're most comfortable with. For most people, they invest via a platform. So this is a company such as Hargreaves Lansdown, AJ Bell, or like with me, I'm with Vanguard. Vanguard for me just offer what I want from a platform. It differs for everybody. There's no real set rule of thumb as to what's the best one for you. You just have to do your research on each. Once you've worked out that, I look at the service they offer. So do you need somebody that you can pick up the phone and call? Are you happy to have someone deal with everything remotely and just get an annual letter through the post? This level of service can differ for each person. With Vanguard, I don't really have much need to talk to somebody, so I'm quite comfortable with just receiving mail or emails as and when. I don't need to pick up a phone or talk to someone on a daily basis. Once you've done that, the next thing to look at is the price. Now the price differs for everywhere you go. I pay around 0.75%. I'm quite comfortable with that. It fluctuates with different platforms. Again, like you get what you pay for, and the cheapest isn't always the best. Vanguard for me is fantastic. I love it, but it might not be right for you. So I'd encourage you to do the research on the 3 areas I just discussed. You can also directly invest through an asset manager. They can easily access trading systems and it's easier for you to manage your portfolio. The costs are slightly more than you would normally pay for a platform like with me with Vanguard, for example. It's more sort of a personal service, and it's, I think, personally for people that have a more in-depth understanding of how it works and need to know on a regular basis how their money's doing and are quite comfortable moving money from one pot to another. So again, do your research on that. It isn't right for me, but it doesn't mean it's not right for you. I started out investing with apps on my phone. So I started out with Moneybox, which pretty much just deals directly with ETFs. I then moved on to Free Trade and Trading 212, which I still use them today. I absolutely love both of them. And they deal with shares, they have some ETFs, but it's mostly shares. It's a really simple way to get your money working for you. You can open, like I said, like a trading, like stocks and shares ISA with both. And Trading 212 doesn't charge any monthly fees. Free Trade does. The last time I checked, it was £3 a month. So you need to make sure you're putting enough in to warrant paying that fee and you're making enough back each month. But aside from ISAs, you can invest in shares in whatever company you like, providing it's on there. Every month they're adding a lot more. So it's growing quite fast and the interface is really straightforward. It's just a really friendly way to access the investment world, and getting your money back out is quite straightforward. Selling a share and clearing that money back into your bank account. It's a nice seamless process, and I'd recommend to anybody to use either of those just to get you started off and just to test the water. So now hopefully you've decided how you want to invest your money and you specifically know which company or platform you want to go with. But what do you invest your money in? You want to try and create a really diverse range. So different companies from different sectors, from different geographical locations across the world. The more specific you keep your investment pot, the higher risk that you're putting yourself up for. So if that sector goes bust, like the travel industry at the moment, your shares are going to take a real hit. Spreading that money out and maybe just keeping 5% within travel is going to really spread your chances of doing well. And one sector may rise, one may fall, but overall it's going to even out. So it's a really good way to manage your money, and I'd always suggest to try and spread it across different areas. If you do decide to target specific independent shares on specific companies, just do your research very, very thoroughly. Learn how to read their balance sheet and their financial statistics. This will give you a real understanding of how the business is performing and if it's the right company for you. Is it too much of a risk? Is it more steady? These are things you can all gain if you learn to read this information properly. I will do a video on this for you. It can be a bit of a weird area to try and understand on your own, so we'll hopefully break it down for you. Just try not to get too swept up with hot stocks. There are so many YouTube videos out there pumping you with information about the hot stocks today, the hot stocks for this week, for this month. And I never really know how genuine they are. I've never really followed the herd when it comes to that. If I'm putting my money into something, I want to do my own research and make sure that I'm really, really confident that it's going to a specifically safe place. I don't want to just throw it into a company because I recognise the name or I saw them on the news last night and then something's going on with them. You want to fully understand where your money is going and what that company is going to be doing with it. A good rule of thumb is that if this is something that a cab driver has recommended to you, the chances are it's a stock that's already peaked and it's probably on its way back down again. So you want to get in early, and having people tell you the stock's doing really well, it's really, really performing great. Okay, that's fantastic, but by that point, the growth has already happened. 9 times out of 10, it's not going to continue growing that much more. So you need to get in early, and that's just through research. Just read as much as you can. Financial pages on various websites online can give you lots of information about how companies are performing, any mergers that are coming up, any deals that are going through, and these are all things to keep your ears looking out for and just keep an eye out for, because anything you can do to get yourself ahead of the curve, you can get in early and potentially make a significant growth. But failing all else, just look at the fact sheet on the Investment House website, and it should hopefully give you everything you need to know about your investment and where it's going to be going and if it's a good choice for you. So now you've done your research and you're ready to put your money into a company, just take a breath and wait. There's no real rush. Don't get caught up in the media or the hype of a stock doing well. Just bide your time and wait for the perfect opportunity to put your money into the market. This whole crash with coronavirus is a fantastic example. I put money in right at the peak just before the drop, and I had rumours and rumblings about stocks sort of maybe having a drop, but I got so caught up with seeing things going into the green and rocketing up in price that I just jumped in with both feet, and eventually them stocks crashed. And I mean, I've regained the money now and I've put more money in at the bottom, but I wish I'd held out a little bit longer. There are always fantastic buying opportunities. The crash this year is a perfect example, and they do go up and down all the time. So it is always good opportunities to sort of swoop in and get a good price. But just remember that anything you put your money into is for the long haul. Any sort of peaks and troughs, ups and downs over the next few years really are irrelevant. The only two prices you're considering is the fact what you're buying it at and what you're going to sell it at. Anything in between is kind of pointless and irrelevant. You don't really need to know about it. It's like a house. If the house market starts to drop, the last thing you're going to do is put your house on the market. So while this shows in the stock market being different, just hold on to them for as long as you possibly can. If you are still nervous, just invest money in dribs and drabs at an amount you're comfortable with on a regular basis. This just reduces your exposure and level of risk. Putting in a huge lump sum of money right at the beginning, the price is rising and then dropping. You don't want to be doing that. If you can put money in regular intervals every single month for the same amount, it's going to be consistent, whether the price is up here, down here, like wherever it may be, you'll just be sailing through, and it should average out much more evenly than if you put a big lump sum of money in right at the beginning. This process is called dollar cost averaging, and it's a really great way to try and make the most out of your money and reduce your risk as much as possible. Of course, it's not guaranteed and the market's volatile. This is just a really safe bet way to try and reduce that risk. And it's the method that I use. Lots of people I know use it, and it works quite well. The earlier you can start investing, the much more time you give these powers to create this extra income for you. Compounding is great. The earlier you can start, the greater your rewards are going to be. There are various compound interest calculators online you can look at to use this. I'll link one below for you. But yeah, the best time to start is today. You can't go back in time and start from a year ago or 10 years ago or even yesterday. You can only start from now. So really think about it, do your research, and just do something with the extra money if you've got some. Hopefully you have. I really hope you're in a good position, and I want you to make the most out of that. So I really hope you got something from this video today. It's a bit longer than my normal videos, so I apologise for that, but there was quite a bit to cover. I will do some follow-up videos to explain some of the finer points in more detail, but this was really just to give you a general overview of your options and to give you something to start working with and start doing some research. Leave some comments below if you have any questions. Any feedback you have, I really appreciate it. And let me know if you have any success stories, anything you can find which has helped you. Let me know, I'd love to hear about it. Like the video, please subscribe and hit the bell icon so you don't miss any more in the future. Bye guys.